First rates, Monday morning, after 2 weeks of consolidation, it's a flat start. Absolutely flat. Red, green, that direction does not matter, but the fact that you are there's a complete flat print. Breadth is looking meaningfully better in terms of what the breadth is. You're going to start with Tata Motors and Cipla. There are two numbers which came on Friday. Tata Motors after market hours, Cipla during market hour. Tata Motors is where you will see a result reaction. Let's see what the result reaction is. I don't have it on my screen, but it's a 17 rupee uptick for Tata Motors, which means the markets are saying hello. These are good numbers and they need to be rewarded. I was of the view that it could be a case of buy the rumor, sell on news, but markets are markets. They sometimes don't go in the way you anticipated. Cipla, and then you want to look at DMart because for DMart, for the quarter gone by, things were not very impressive. They were not impressive at all. So Cipla's down. There you go, Aisha. I mean, nothing, numbers were not howler, but it's an expensive stock and a little bit of slip here and there, and it just becomes a casualty bomb for me.
Yeah, let's see whether these dips get bought into or not for Avenue Supermart. Rarely do you get such price action there. But by the way, it's not just Tata Motors alone. There's impressive set from Colgate as well. The numbers have been in line. EBITDA has shot up about 5.25%. Colgate too starts off in the green. DLF was a very good set of number, especially because the net debt has declined 2% higher for DLF. It's now nudging 445 per share. Manappuram Finance as well, Q4 above estimates. VP Nandkumar has got the interim stay order from the High Court. We're going to be chatting with the management as well. Naveen Fluorine was another good set of number. The margins have clocked in at about almost 29% versus 23 on a year-on-year basis. Revenues have shot up about almost 70%. HPCL 2, wherein the margins have risen about 330 basis points on a sequential basis. GRMs are above estimates. Ami Organics, Advanced Enzymes, Rainbow Medicare, these are all good set of numbers, and you are seeing positive reactions come in here. RVNL, the joint venture has bagged another order worth about 2,250 crore rupees for an irrigation project in the state of Rajasthan. RVNL shoots up another 7%, and why we mark this stock is because some of these names saw a steep correction play out in the last week. IGL though, that's been a disappointing set. Their Q4 volumes have come in below the estimates. Revenues as well have come in flat on a sequential basis. Max Financial too, the VNB margins have come in lower than what they had in the same quarter last year. The total APE though is up 38%. Max Financial too lower by about 2.25% as we speak. APL Apollo, Sonata Software, Affle, Lakshmi Organics, these are all set of numbers which have fallen short of market expectations. Sonata down 7% now. And Affle as well, we just chatted with the management, although they are hopeful of a recovery come by. But Affle has taken quite the knock. It's down 4.25% as we speak right now. But the bright spark here is Tata Motors surely 3.5% higher on that stock. Kunal, what trades are you punching in considering you already have Tata Motors in your portfolio?
I think Glenmark is the other stock which looks attractive, trading above that 600 mark, confirmed a breakout sometime back, looks attractive. So that's a stock which I would continue to be, I was bullish on it in the last 1.5 odd week, would continue to hold on to the stock.
Okay, Glenmark it is. Kunal has been reiterating that this is a stock that he's very bullish on. What about you, Naresh?
So that would be L&T. The stock has come down a bit post the numbers, giving a good opportunity, expecting it to bounce back from it.
S. Naren joins us now. He's Executive Director and CIO with ICICI Prudential AMC. Naren, good morning. Thank you for joining us.
Good morning.
Exactly a year ago, there was fear, there was no excitement, and there was low participation. Now there is perhaps concerns are getting addressed, FIs are back, and in terms of fear, the fear has evaporated. What do you make of the current market setup? I'm speaking your terminology, Naren, learned it from you, fear and greed.
I think we are in the middle. That's the challenge that, you don't have a situation where I don't think we are in greed. If you have greed, you will have huge local mutual fund inflow. If you look at the mutual fund inflow data in April, it was one of the lowest in recent times. And if you look at most of the new fund offers, the new fund offer collections are also not very high. So we are not in greed situation like what we had in 2021. So we are neither in greed nor we are in fear. So we are somewhere in between. So we are in a moderate return environment is what we think at this point of time. So we don't need to be at two extremes always. We can be somewhere in between also, isn't it?
On the macro picture, Naren, what is your take? Worst of inflation is behind us. Would you agree that? And if that is true, what does that mean for equity and bond market?
I think the macro picture is fantastic. If you ignore anything that can happen in future, because if you look at the current account, for example, which is one of our most important indicators, we used to fear about current account last year in this phase, and the trade deficit, which we look at not just goods, we look at goods and services put together. That number was looking pretty negative, and over the last 3-4 months, if we look at trade plus services, that number looks much more comfortable. That we have ceased to worry about current accounts. So that's one thing which is gone. If you look at inflation, I would say that inflation worries are lower, but in the way inflation index is constructed, we have to keep in mind that we are talking of just ahead of monsoons, and people are scaring us on account of El Nino and things like that. So that we have to little bit worry about monsoons, and therefore, but at this point of time, oil is the other product we always worry about: oil, coal, fertilizer. I think that basket, I think the worry has kind of disappeared. So I would say that, in fact, OPEC is forced to cut production to maintain prices. So which means that we don't need to worry about it. So I would say that that is a worry which is lower. I think the superb steps taken by the government in terms of improving the digital footprint to improve compliance in direct tax, the kind of GST collections that we are getting at this point of time, all those things are certainly helping tax collections. That I would say that the fiscal situation is reasonable. So on the whole, I would say the macro is the biggest positive at this point of time, and I would say that unlike other countries which overdid the fiscal and monetary bit in 2020-21, we did not, and that's why we don't have the inflation problems that the Western world is staring at it over the last 1 year. That's why the macro is not the problem at this point of time.
Okay. Naren, in the overall scheme of things, how much importance would you give to the election cycle? Today we are acknowledging it, but 6 months from now markets will be talking about it. Naren, are you there? Okay, is he ready? Can I go to him? Up, zoom out. Okay, there's a bit of a camera problem. Sometimes it happens when you're doing live television, just pure compulsions of, live television, so to speak. Can I go to Naren? Is he ready?
But it's interesting, Nikunj, because he's talking a lot about how, the macros as of now are looking fairly resilient, and there is uncertainty on the inflation front, Nikunj, when it comes to monsoon as well as El Nino, but otherwise, that's moderated.
Naren, in the overall scheme of things, what to your mind will be the importance of the election cycle? Simply because today we are acknowledging it, 6 months from now few will start talking about it, and in May 2024 everyone will talk about it.
Preparing for this meeting, I was just thinking, if you look at 2003-4, 2008-9, 2013-14, 2018-19, you had a situation where all the years you had volatility. And what that means is clearly, funds which benefit out of volatility, like hybrid funds, will definitely benefit because you have seen volatility in all the election years. And there is absolutely clear that volatility is given in election years. If you go back and look at 2003, 2003 markets were dirt cheap, and 2003 kind of market we are not seeing at this point of time, because market is no longer as cheap as they were in 2003. They are much, much more overvalued compared to 2003. To factor in 2003-4 is impossible. So I would say we have to, when you think of the election cycle, we have to believe that we are going to have some amount of volatility in the next 12 to 18 months. And that is why for us, both systematic investment plans and hybrid investing for lump sum, which is categories like aggressive hybrid equity and debt, balanced advantage, multi-asset, equity savings. These are all the ways to go for the next 12 to 18 months, along with systematic investment plans and systematic transfer plans. Because volatility is not going to go away in the next 12 to 18 months, both for global reasons due to the Federal Reserve and due to local reasons because of higher valuations. And that is how we think when we looked at where we are today.
Naren, as per the last disclosure data, if you look at your funds and if you look at the disclosure data of some fintech and consumer tech companies, ICICI Prudential AMC has been a buyer in them. You avoided this sector for 2022, but do you think right now the setting on the table is attractive to buy into some of these consumer tech and fintech companies?
Basically, in our principles, as you know, we are contrarians, and when we find that companies are getting more attractive on valuations, and many of these companies have done extremely badly in the last 1 year, as you know. And most of those holders which were holding, they actually have been getting out of them in a very, very big way. So we saw an opportunity to look at those stocks as they fell. And they have been the worst performing stocks in the Indian market. And we are not opposed to looking at anything as long as we feel that the embedded value in them becomes more attractive. And that is the framework which we use for investing. And, many of our older sectors which we were which we liked a lot, many of them have done extremely well. With our open approach to investing, we thought, why not consider them? But if you look at as a percentage of our assets under management, they are negligible. So while the market talks about our investing in them, if you look at the absolute percentages of our corpus, they are very, very small. But yes, we are willing to look at them. We will, if many of the new companies also come in them, which are more, they come at much more cheaper valuations. I don't see why we should not look at them if they come at reasonable valuations.
Say IT services, is it worth a contra thought now? Is it looking attractive enough? Is it like buying banks in 2021 when nobody liked them?
It is certainly a contra thought, but if you look at it, it is just one or two companies which have really crapped out, and they are certainly worth a contra thought. And we need to understand why those companies did so badly. Normally in a sector, what we have from our experience, small and mid caps will do much worse than the large caps. But this time we have had a situation where some of the large caps have done very badly and some of the small and mid caps have delivered good numbers. This is something which is surprising to us at this point of time, but it is something which we are focused on. And, on top of it, you have disruption worries like ChatGPT, what it will do to the sector, etc., etc. So we have to look at that part. But if we did not have the disruption worries, I would say already they have come to an attractive level. So barring the disruption worries, I would say that they have already buying price worthy relative to the market. So we are doing the work at this point.
Then you bought a lot into NTPC, Power Grid, utilities, and that was like a very, very boring call when you started buying into it. Why is ICICI Prudential and why is S. Naren and his team buying into some of these stocks which essentially have been the dogs of the market? Now guess what? That call has worked like a charm. Is the best of the gain in some of the power utilities, power generators, power producers behind us?
See, the reality I'll tell you is power is a long cyclical. Power, real estate, these are all long cyclical. They are not going to go down suddenly one day. If you look at power demand, it's going to shoot up in the next 3 to 5 years. People talk of China plus one, Europe plus one, data centers, everything. Everything requires power. So power demand is going to shoot up in the next 3 to 5 years. So the demand for power is going to keep on going up with electric vehicles and everything going up. So I don't think power as a sector is going to do extremely well. Now, at what price point do these sectors look overvalued? And some of these companies have done the brilliant step of moving into renewable and building very, very good renewable footprint, improving their ESG footprint, focusing on the renewable area in a very, very big way. And along with that, I would say that both the governments have also improved by focusing on the DISCOM financial situation has also been improving. So you have multiple positives which are happening in the sector. So, we really do not have to worry about it. But the reality is it the time to increase weightage in these sectors for someone like us who have hitherto been very, very bullish? The answer is no. But is it the time to get off the street? I don't think so, because power is something very basic, and where even electric vehicle means that demand is going to go from oil to power, and all these companies are going to set up a huge solar and wind and renewable footprint in the next 5 years. So I don't see any worries.
So, Naren, what is cheap? Where do you think right now there is fear and markets are mispricing future growth?
Actually, this is where the debate is. We are in the middle. And, it is boring to say we are in the middle because, if you really thought that it is very nice to be in extremes. And, when you're in extremes, you can actually make bets on either side and take a very, very big bet. But today we don't have those extremes. And we have to recognize that we are not in those extremes. And so, last year, 6 months back, there was extremes in global markets. Global markets had turned extremely cheap. So after that, India underperformed a lot, and that extreme also got removed. So I would say that today we are not seeing any big extremes. And consequently, what is relevant at this point of time, which is that we are in a moderate return market. And I would say that a moderate return market with some amount of volatility in the next 18 months. And India is one of the best structural stories in town, given that we are geopolitically in the middle. And that is where we are at this point of time. And we can't identify areas at this point of time where we can see extreme greed. We can't identify areas where we can see extreme fear at this point of time. And that is a reality. We have had good periods where quality has done very badly. We have had periods where value has done extremely well, which is well reflected in some of the funds. So we have to be in the middle at this point of time, and it's okay to be in the middle. One doesn't need to always be in extremes. And this is the learning. And you can see that, some of the auto stocks which people believe will never do well have come out with outstanding numbers at this point of time. And, very many of the PSUs, which, people used to criticize, have all done extremely well in the last 3 years. So this is not the time to go and say that, every time you have to be contrarian. But we are more open today to look at quality. We are more open today to look at some of the new age companies. We are looking at sectors which have done badly, like technology and pharma, with an open mind, and see where we can actually increase weightages at this point of time. But we are not in extremes.
So if you're right in the middle, what will happen to returns then? Like single digit returns? Because it's only in extreme the returns they change.
Exactly, very tough to give these numbers, but instead of saying single-digit returns, we actually say moderate returns. What does moderate return stand for? Does it stand for high single-digit? Does it stand for low double-digit? These are all questions that you can decide yourself, and that is how I feel more comfortable using the word moderate, because moderate can stand for anything at this point of time. So moderate returns with a bit of volatility is what I believe in saying at this point of time. But I can't see 20% return at this point of time in the markets at this point of time. Neither can I see minus 20% given India's macro, unless something were to happen, an event which I cannot factor and believe in at this point of time. So neither extremes do I believe in at this point of time. Last year at this point of time, there was so much worry on Ukraine, Russia war, oil, current account, etc. Those kind of worries don't exist at this point.
Financials is the most overweight allocation for most of the mutual funds. Everybody is happy with what banks have reported. Credit growth is decent, NPAs are low. But if that is the consensus view and that is the consensus positioning, why do your funds also have a market weight to marginally overweight exposure to financials? I mean, that's not your style. You have to be contra. And financials right now is a consensus call.
Look at the numbers that have been delivered by all the banks. They are very, very good. And if you look at it, if the only reason banks haven't done well is because the flows have not been very high. Even today, if you get $10 billion from FIs, I'm sure $4 billion to $3 billion will go into financials. And that is the challenge at this point of time, is that the flows have not been very large. If the flows had been larger, I can assure you that you will have a situation where financials would have done well. Again, I can tell you, if you're going to have $10 billion of outflow or even local outflows in a big way, financials will do badly, not because of fundamentals, but because of the fact that you have a situation where people will have to sell financials. See, I do agree that you're not going to see a situation where credit growth, net interest margin and NPL, that entire combination will be as good as where it is today. But normally at that point of time, you'll see record valuation that we are not seeing. So that's why we are in this more neutralish view. While we do believe that the cycle of NIM, NPL and credit growth is good, valuations are not at record at this point of time. Valuations are more reasonable. In fact, there is a prominent broker who's known for giving bearish presentations. He has been saying that this is the only sector which is more reasonable in valuations. And he's a person who loves to give sell calls on many sectors on the basis of valuations.
Broker, Naren, who's giving bearish calls on financials? I want to know the name.
No, there's no one who's giving bearish call on financials because it's the most reasonable sector on valuations at this point of time.
Saying there is a broker who gives bearish calls, he's also bullish on financials.
Yes.
So who's this broker who gives bearish calls? Let me rephrase my question. Okay. Naren, last question. Last 12 to 18 months, we've seen an uptick in inflation. Growth stocks have come down because interest rates have gone higher. Now the reverse should happen. Interest rates will not go higher. If at all directionally, they should have a natural decline. What will happen to growth stocks and what will happen to value stocks?
What people forget is that there was a period of time when interest rates were zero. When interest rates were zero, there was only one game in town called growth stocks. If you do believe that in US interest rates are going to go back to zero, again the only game in town is growth stocks. What people tend to forget is that interest rates in US is no longer zero. Interest rates in US is 5. Now, the only thing people are saying is interest rates will stop going up. They will not go up from here. But no one is saying interest rates go back to zero at this point of time. So I think the world is more balanced in terms of growth, quality, and value at this point of time. And I'm not a believer that like last 3 years or 2.5 years that value alone will do well and growth will do badly. But it's more balanced. If you believe that interest rates will go back to zero, I think it's going back to growth only. So I think now we have to do stock picking across growth, quality, and value. and we have to do the right things. That is why today, if you look at the market, there are, for example, a value stock in the auto space has done well, a growth stock in retailing has gone down, and a quality stock in pharma has gone down, if you take today as an example. So I think we have to do stock picking across the sectors, and it is going to be more balanced. And the job for a person like me is to find contrarian ideas in growth, value, and quality, and not say I'll do only value. Then I think I'll become obsolete in very quick time.
You know, Naren, next time we'll have a discussion on AI and what kind of stock, spotting AI is actually doing right now. But today, everybody in my studio is saying that it's a moment in history. We made S. Naren really smile and laugh on air. Last time, I guess you smiled this much was when you got your call on Bharti, right?
Many calls have gone right, luckily. So that is the positive. And, the mutual fund industry has also grown a lot over many years, thanks to the support of media like you also. So that's the real thing, actually.
So now you made me smile when you said that support for media industry. So we both had a good interview. I made you smile, you made me smile. We should plan more interviews where we make everybody smile.
Thank you.
All right. Let's smile.
Staying in the middle suits him. Okay, one more person who should be smiling right now, Ravi Kumar, the co-founder and CEO at Upstocks. They've managed to break even. Remember, this is a Ratan Tata-backed company. They've broken even in 2023. Ravi, hi, good morning. Great to have you on ET Now, and many congratulations.
Thank you very much for having me on the show. It's an honor to be here. Thank you.
Right. So you finally managed to break even, right, this fiscal, and your revenues, as we understand, have already crossed that 1 lakh crore rupee mark as well. Do you think this kind of growth momentum can continue at the same space? Or do you think some cool off in the numbers could happen in the short term?
Look, I think we're a long-term player, right? We didn't cross 1 lakh crore. We crossed 1,000 crore revenue this past fiscal. We've grown 40% in a market which was fairly flat. Nifty March 31st of 2023 versus March 31st of 2022. The index was pretty much flat, but we still managed to grow 40% due to the great platform that we built and the great team that we have. And we remain focused. We became profitable this year, which is, just a long-term vision is to at Upstocks is to just really build up retail equity participation. We think that India growth story is one of the most fantastic growth stories of mankind, and it's a 25-30 year journey for us.
And corrected there, 1,000 crores. Yes, that was the revenue. But tell me, what is the overall strategy, say for the next 3 to 5 years? And of course, the question on everyone's mind is, when are you going to IPO?
The strategy here is, if you look at, say, platforms in the US like Charles Schwab and Fidelity or Vanguard, right? The US economic growth story, just to give you some contrast here, is probably one of the most amazing growth stories in our existence, right? In 1990, if you invested $100 in the S&P 500, today it's worth over $2,000. And we think the Indian economic growth story is probably even more fantastic. So as India's GDP ascends and we become, one of the top 3 countries in the world, it's very imperative that the people of India and the retail masses benefit from this immense growth potential. And so as a platform, we believe that, being a tech-first, product-first, mobile-first platform is the future. We've been able to onboard over 11 million customers in our journey so far. And our vision is in the next 4 or 5 years to onboard another 100 million users and to help the masses really optimize their wealth creation journey. I think the simplest things are the best ways to invest in India. Just buying into a low-cost ETF and SIPing your way into it month on month can just generate vastly outsized returns. And that's our plan.
If I look at what your peers are indicating, whether it is Zerodha or Angel, one is listed, other one is not listed. We get, updates on a quarterly basis. They are talking about a decline in market share. They're talking about a slowdown in demat accounts. They're talking about markets coming down, retail traders going away. And that's the basic nature of the broking business. How come that's not been a challenge for you?
Look, I think markets are always cyclical, right? And we're always kind of linked to the way the index is doing, the overall broad market index is doing. Nifty remained flat this year, but it still fared much better than global peers. So again, we don't really focus so much on just short term. To us, it's a 30, 40, 50 year vision. The Fidelities and Schwabs of the world have been around for multiple decades. Fidelity's been around for 70, 75 years. They've helped 45 million households in America just participate in the great economic growth story. So we're trying to build a brand that really lasts, for a long time. And because we're profitable now, there is no, cash issue at all. There's just, it's just the vision just to build profitably and to build over time. So short-term vagaries will always be there, like any industry. We are cyclical in that sense, but the midterm, long-term positioning of the Indian growth story is just incredible, as you and I all believe. So that's the way we look at it. So this past year, I think because Nifty was a little bit flat, our space generally felt that pressure a little bit. We've been able to outgrow it a little bit because we focused on quality customers. We also, have an amazing branding presence on platforms like IPL and ICC, which have really helped us scale from a branding perspective. So these are the things that we did differently, I believe. But every story is different, and again, we're all just trying to get the masses to be a part of this wonderful economic growth story.
Trend, what you see in your clientele, is it coming from small towns, large towns, the same folks are trading more? What is the trend for us, which could be a very broking stroke India specific trend according to you?
So almost 85% of our customers now, new customers now, are all from tier 3 towns, tier 2, tier 3 towns, which is where the growth is going to come from, right? Equity participation in India today is still barely scratching 6%. In the US, it's over 50%. Even China enjoys over 20% retail equity participation. So we have so much headroom left, and as the Indian market grows, it's very important that we all play our part, right? And just helping people manage these savings and just direct them towards, high quality equity markets, high quality equity stocks. And that's what we try to do. So every day is what we focus on, essentially, when we come into work.
Hi, maybe we're harping on the same thing when we're talking about the earnings trajectory, but I only ask because some of the peers like Zerodha, for instance, they have acknowledged that there could be a bit of a tough FY24, earnings could take a hit. So you're confident that looking at the long-term growth story, the kind of traction that you're seeing in tier 3 towns, etc., that this will not be impacted? Any projections that you can give us in terms of your revenue as well as profits?
See, we've generally been almost doubling revenue on average every year, and this past year was a little bit more tepid because the market itself didn't grow so much. But that's a guidance for our way forward as well, I would say. And again, because we're profitable now, there's no really, no pressure for us to, do some crazy growth story or something like that. But generally speaking, I'm just generally extremely bullish. I think short-term trends will always remain. It's hard to exactly predict which way the market's going to go 3 months, 6 months from now. But from a multi-year standpoint, the story is vastly up. That's the way we just look at things. I think we're also profitable now, so I think we expect to end this fiscal with probably 25%, 30% PAT, and just keep growing.
Ravi, tell me, but are you looking at expanding any other new digital product launches, cross-selling services, anything that's in the pipeline?
Definitely. I think the India fintech space overall is just absolutely incredible. The government's done so much to just help platforms like us digitize. And it's very easy, for us to just launch and bolt on new products. So, we could get into we can get into an AMC kind of a thing. We can get into lending. We can get into neo-banking, insurance. All these plays are open for us. But the vision we have at Upstocks is, when you walk in through that Upstocks door, how do we help you confidently, increase your wealth, up your wealth? That's the reason for that's our reason for existence, and whatever we do in that process to help you manage your wealth better, we will do. If that's banking or if that's lending or if that's insurance, we're game for that. But the main motive for you to enter our brand should be to just up your wealth.
Good to know, and I'm sure a lot of retail investors as well will like that comment. Thank you so much, Ravi, for joining in and sharing with us your growth projections as well as what the outlook is when it comes to retail participation as a whole. With news that we're at 18,367, we take a quick break. Don't go anywhere. The management of Manappuram Finance and Sona BLW join in after a short break.
Back with first trades right here on ET Now. Let's address one set of earnings, and this has surely been a stock which has been in focus. So let me welcome on board VP Nandakumar, the MD and CEO at Manappuram Finance, to talk about their quarterly performance. Mr. Nandakumar, great to have you today on ET Now. Let's first talk about your numbers, because you've managed to increase your gold loan AUM growth guidance to about 10% as opposed to 6 to 8% earlier. How much of it would be on account of the rise in gold prices, and how much on account of improved customer attraction?
So I don't think the gold prices would help to increase the portfolio, because people borrow the amount as per their requirement. So with the gold price increase, what they used to do, the quantum of pledge, the gold ornaments coming for pledge, it will get reduced, because for a lesser quantity they will be able to meet their requirement.
Okay, so then the non-gold loan business that has posted decent growth this time around. What is the outlook on this product segment in terms of what your contribution as well will be to the total revenue pie down the line?
So our long-term expectation, what we have told from 2014, is to reach a level of 50-50, 50 gold and 50 non-gold. Now we have reached a level of 44%. So the thrust on non-gold also will continue, while we are hopeful of growing gold loan by 10% this year. That is our plan, etc. So we hope in another 2 years' time we will reach that level of 50-50.
Sure, but is the improvement in asset quality in the non-gold business, is that sustainable, and do you see it improving further?
Yeah, you would have seen that asset quality improved from the previous quarter. So I believe that it is coming to the pre-COVID level. It has come to almost the pre-COVID level. So and growth is also going to be reasonably as per our expectation.
Okay, what is the outlook then when it comes to your cost of borrowings? Because the interest rate environment has been, and right now, maybe not that lucrative. Do you see your borrowing capability being impacted on the back of the recent ED investigation?
No, that is not impacted, because the bankers know this is not a new issue. This is a very old issue of around 12 years back. So that's the issue, and we got a stay also. So I don't think that it will be the borrowing will be backed up. The renewals also we are getting.
You're saying that what has happened with the ED raid, none of the promoters have got any real impact. The listed entity will not have any impact whatsoever.
Yeah, it has no impact.
But when is the next hearing in the High Court? Because you moved to the court, when is the next hearing?
It is on 25th. It is posted for 25th. Now the court is having the vacation. So the courts don't have the time to hear. So they have granted an interim stay and posted for the hearing on 25th.
ED raid forcefully change anything at the leadership level?
We don't anticipate it now.
Okay. Could you just clarify what was the issue?
It's an old issue where the regulators are also aware for the last 15 years, and we have been taking action as directed by them.
And what is the status on the RBI? I'm asking you tough questions, but you'll appreciate that the reason why I'm asking you these tough questions and direct questions. What is the status on the RBI show cause notice which was issued in Jan?
So the personal hearing is over, and we have explained our stand. So we hope the impact, or there may not be a serious penalty. That's our expectation.
That. But historically, when we've seen that when these issues have arisen in the past with other companies, it has always led to a change of business strategy, in which growth in the near term it gets compromised. Could that be the risk for Manappuram Finance?
I don't think so, because our asset quality is improving, our earnings are improving, and we have a very long banking relations with the banks. So I don't think so.
I'm going to shift gears and back to business, and I'm going to talk about the housing or the HFC business which you had incubated a few years ago. Now the HFC space or the home loan market is getting extremely competitive. What is your plan to grow that business?
So we are targeting more of our own customers. We have a very large customer base, both in gold loan as well as microfinance, etc., who are in need of affordable housing. And our average ticket size is around below 10 lakhs. So with that sort of customer base, we are confident of achieving whatever is our plan for the year. Previous years also, whatever we have planned, we could achieve on the strength of our own customers.
Okay. And just to wrap it up with one final thought, that now that interest rates have topped out and you largely borrow also from the wholesale market, what happens to the borrowing cost for rest of FY23 and FY24? Because automatically that has to come down.
Yeah, we don't expect an increase in the borrowing cost. Why? Because we had an external borrowing through dollar bonds. So that was costly, and that got redeemed. Some of the other borrowings where the cost is high, that also is getting redeemed. So even though there is a price increase as far as new borrowings are concerned, when we balance with that, the impact may not be that high.
Okay. All right, really appreciate your time. So glad you could join us, and certainly hope to see much more of you going forward. Vivek Vikram Singh joins us now, Managing Director and Group CEO with Sona BLW Precision Forgings. Good morning. Thank you for joining us. I'm going to start with a very basic question. Can you just share with us the big picture in terms of where demand and the OEM forecasting is likely to move for the rest of the year?
So are you asking about the Indian market or the global market?
I'm talking about the global market, because there are a lot of yes and no. 6 months ago, we were talking about supply chain issues. Now we are talking about demand getting challenged in the global market.
So Nikunj, if you look at the last 3 years, it's been challenging pretty much every single quarter, every single time, right? We first started with COVID, then we had the Russia-Ukraine thing, semiconductor thing, and now we are talking about the demand crisis. Despite all this noise, every year through the last 3 years, we've grown by over 25%. I think some of these challenges are going to persist, and if something has been the trend for the last 3 years, I don't expect much to change. I think what we have to do on our own steam. We have to do on our own efforts and order book. I don't think there are any industry tailwinds yet for anybody.
So how does that, Vivek, spell into your numbers? Because as I understand, and please correct me if I'm wrong here, EVs contribute about 28% in your revenue, with 77% of contribution in your current order book. How do these numbers stack up for the financial year? Do you see them growing?
So last year we grew about 26% year on year. So you're right. I think because we are in the segment of the industry that is growing, we have managed to grow far beyond the industry growth. I think that is the right way. And your question is actually fairly intelligent in that sense, that in any broad, big industry, everything will not grow. What you as a player in the industry have to choose are the segments that you cater to are growing, are the markets you cater to are growing. I think because we cater to the fast-growing electrification trend, that is the biggest reason behind our growth. And You rightly said the order book, 77% of it is from electric vehicles. So we continue to have that growth. We don't give future guidance, but like I said, we've never been below 25% in the last 3 years that we've been sharing our results with the public. Even before that, I think our 22-year CAGR is above 30%. Even our last 7 years CAGR is about 30%. So yeah, we are fairly confident, but confident not because of industry trends, but because of our own efforts and our order book.
Okay. When you say there are no tailwinds in the industry, now that's a big comment coming from you. Why do you say that?
I was appointed CEO in February 2019. I've never seen any growth. So perhaps my view is colored by that in the last 4 years, if you look at the world, 2018, 96 million light vehicles were sold, right? Last year, I think it was south of 80. So we've seen almost a 20% drop in the global light vehicle sales. If you've seen only year-on-year decline, to say that have a reason that it will go back to 96, I don't see any big reason yet.
Dropping, then where things are headed for the business which you represent? Ultimately, you are an ancillary supplier, and for you to do well, the auto industry has to do well. Now, whether it is semiconductor problem in 2021 or a war, high inflation and war which impacted European demand in 2022, or perhaps regional banking crisis for American banks in 2023, every year there is one challenge or the other.
Correct. So you're right. I mean, then what is the point of having a management if everybody just grows with the industry? Then we might as well be run by ChatGPT, you know. We used to be 1,200 crores turnover when I took over. Last year we ended at 2670. So we more than doubled. I think when we IPO'd, I came on your show. I think immediately after that IPO, and I was asked that there are so many problems in the auto sector. How will you sustain growth? At that time, we were 1,560 crores. So we've done from there on about 70% growth in the last 2 years. Industry has not grown. So what you have to do is you have to launch new products. You have to mine market share into markets that you were not present. You have to grow your wallet share with customers, and you have to keep winning new business. Like I said, the industry is same for everybody, but what you do of your own steam is up to you. And like I said, we kind of demonstrated that in a declining industry, we have managed to grow every year by over 25%, and we're fairly confident we can continue on our growth journey. How much exactly, obviously, every year to year, like I said, we don't give future guidance, but yeah, we're fairly confident.
So you are growing, and that's great news. Can I say that you will continue to grow, and the minimum threshold now will be 25 to 30%, irrespective of what is happening in the world?
So that's been our minimum threshold so far for the last 8 years that I've been working here. Will it continue every year? Hard to predict. We don't know the future, and we don't claim to be macroeconomic experts. Even in the last 8 quarters that we've been listed, we've grown by 0 to 10% 2 times, 10 to 25 2 times, 25 to 50 2 times, and over 50 2 times. Like last quarter was, I think, our net profit grew by over 50%. So these things happen. Over the medium term, though, we expect that, yeah, we should be able to continue our current growth rate. When I say medium term, I mean 3 to 5 years.
Hypothetically, if I'm engaging in a similar conversation with you 3 years from now, I'm talking about 3 years now, what is the bare minimum we should expect from you?
Yeah, like I said, I mean, 3 to 5 years, we should continue with that growth rate. Again, we don't give future guidance. And the thing with the 3-year period is in 3 to 5, you will see it. Now, whether the third year is a year with a massive global recession, say. So you don't want to commit to a particular time or a particular year. But yeah, the trend or the trajectory is something we can manage. How we manage that is by winning new orders. As you know, in auto, you win orders quite far in advance. A car is not developed the next day or the next week. It will be launched 2 to 3 years out. So when you win today, what you're solving for is 3 years out. So whatever efforts we put in this year or the next year, we are actually working on 3 to 5 years.
Capacity utilization, if you're growing at 20%, 25%, your capacity utilization would be nearing its peak, I'm imagining.
Not really. I mean, we have been investing a lot in the last 3 years. So we are constantly investing. You're right that it is a business in which, again, I mean, this is what I just shared with you was just from our IPO. When I started working here in 2015, FY16, we were 350 crores. So we've grown almost 8 times. Of course, we've been investing in capacity all the time. We are very conservative on capacity, so we don't let it breach the 80-85% for any product category. And we are always investing. So over the next 3 years, I think we should be doing about 1,000 to 1,100 crores capex to grow our capacities.
All right, really appreciate your time and so glad you could join us.
Thank you, Nikunj. Thank you, Aisha.
Bothra, are you ready? Kunal Bothra, are you ready?
Yeah, I'm absolutely ready.
Okay, can we go to Kunal
Ready
Bothra?
for the last 5 minutes.
Yeah, in fact, we have that Chartbuster segment. So let's find out which charts our chartists are dissecting, what's setting the charts on fire. And we've got a banking name, Kunal, ICICI Bank.
Well, yes, Avan, and most of the banking stocks actually did well on Friday, specifically the likes of IndusInd Bank, which managed to come back about the 1200 mark. But then ICICI Bank is also very interesting because the two important points for the stock on the short-term charts, one is the swing breakout. So the stock has this odd tendency of whenever it manages to cross back about the previous swing breakout, the stock gets into an uptrend which lasts for at least 2 to 3 months. We saw this in 2020, we saw this in 2021 when the stock confirmed a breakout the previous swing high. We saw the momentum carrying the stock at the high end of the channel pattern. Even this time around, the stock is nearing towards a breakout of the previous highs. I think 960 approximately is the previous highs for ICICI Bank. And my sense is that the similar behavior could probably be repeated for the stock, and we can expect the upper end of the channel pattern to be taken out. So maybe that's around the 1040-50 mark. The more intriguing pattern is the jump in volumes. Now look at the jump in volumes for ICICI Bank over here as compared to the average volumes for the stock maybe over the last 1 year approximately. So that's a significant increase in the jump for ICICI Bank in terms of volumes, indicates that this is a very strong uptrend, something which we've not seen for ICICI Bank in terms of volumes over the last 1 year. So this could be a leader stock back again for the private sector banking names, and looking at the charts, expecting 1040-50 as a positional target for ICICI Bank.
Okay, there you have it. Those are the levels to track on ICICI Bank. Naresh, you're certainly ready. So what's the stock that you're flagging off today?
Recommended in the morning, Ujjivan Financial Services. If we look at the chart, the stock went through a deep correction in March 2020, and then again came back to the same prices or below that in March 2022, and then has made a strong recovery over the last 1 year. Retested 300 to 320 zones, corrected back to 240, and now we are back into that 300 320 zone. So it's a huge cup and handle formation over the last 2 to 3 years, and the stock is still available much below the pre-COVID prices. So finally seems the trend has been changing, the pain is out, and this could slowly and steadily go back to pre-COVID prices. So a target price of 360 to 400 in the short to medium term. A buy at current levels as well as on dips with a stop loss at 290.
Right, okay, let's get some stock ideas going as well. Naresh, on your list?
So first is the buy on Godrej Consumer. The stock recovered sharply after the Raymond deal. The stock fell and now we are back into a new 52-week high. That indicates fresh momentum. Stop loss at 980, target price of 1100. Second is a buy in L&T, which has corrected over the last few sessions. A stop loss at 2180, target price of 2400.
Sure. Kunal, what about your stock ideas?
So I'll go with the contra buy on ABFRL, expecting the worst to be probably behind and as well as priced into the stock. Targets of 216, stop loss at 193. And the second will be a buy on EU Bank. That's a stock which has confirmed a breakout on the upside about that 700 mark. So keep a stop loss of 690, targets on the upside 750.
Okay, let's take a very quick break on that note. Before that, let's just take stock of where the market has settled in at. While it was hinting at a quiet start, we've picked up a little bit, and the headline number on the futures is now nudging that 18,400 print. DLF, of course, has reacted very positively to its numbers. It's a 5% move there. Tata Motors holding strong by about 3.25%. And today, technology is also really participating in the move. Tech M, Infi both are winners in today's trade. There's also Britannia, there's Eicher, there's Asian Paints and Unilever. All are holding steady in trade as we speak. Quick break, lots more lined up on the other side.